Welcome to Locking Your Success. We are the company that creates strategies to build wealth. This webinar reviews real-time hypothetical trades each week while analyzing market conditions with adjustments. Questions are always welcomed, asked, and answered. Before we get started, we need to go over our disclosures. Locking Your Success LLC is not a broker-dealer or financial advisor. This presentation is for educational purposes only. This information is not an offer to buy, sell, or hold securities. You shall be fully responsible for any investment decision you make, and such decisions will be based solely on your evaluation of your financial circumstances, investment objectives, risk tolerance, and liquidity needs. Please visit cboe.com to find and review the options risk disclaimer prior to placing any trades. Also, please note that these are real-time but hypothetical computer-simulated trades and results. The trades are believed to be as accurately presented as possible, however, they are not guaranteed as to accuracy and therefore live results may vary. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Whew! Now that that's over, let's get to it. Here is your host, John Locke.
Welcome to the Locking Your Success Options Trading for Income Weekly Update for September 14th, 2015. If you happen to be watching this on YouTube or via podcast, please come on over to our website at lockeinyoursuccess.com. That's L-O-C-K-E, inyoursuccess.com, and join our mailing list to get your free report, The 7 Secrets to Becoming a Successful Trader, and to sign up for this free weekly webinar. Also, we have been getting a lot of new people joining us, which is awesome, and I've been trying to get, I've been getting a lot of questions on exactly what we're doing here, which is completely understandable if you've never heard of me before, of course. So let me give some context to what we're doing here. So the purpose of this update is to provide real-time examples of from 4 of our market-neutral trading programs. We demonstrate how the systems work when the guidelines are followed as they are outlined in the programs, and we provide results from these trades over an extended period of time so that you can observe how they perform. The update itself acts as a free support for newer traders because we do have our question and answer session, and hopefully by following along the trades, you'll get some more support that way as well. We also have a market update where I give you my opinion on recent price moves and where I think the market is headed. And the question has to come up, well, why do I go over market conditions? And that's a good question because I do not take market conditions into account with the sample trades. I simply ignore the market and ignore the news, and we simply follow the guidelines as is outlined in the program. But that's not always the case with some of you. Some of our more advanced programs do take technicals into consideration. And for those people, I'm putting out my thoughts. Plus, I think it's really cool how often we can be completely wrong on the market direction and still actually make money. So that's pretty cool. So anyway, we'll be taking a quick look at the market, what it's doing, and we'll cover the 4 trades according to the guidelines of the various programs. The trades that we cover are going to be the bearish butterfly. This is a rule-based trade that can be used as a monthly income trade. It can also be used opportunistically as a high probability bearish directional trade when the market's overextended. The bearish butterfly, most of the time, is the highest yielding market neutral rule-based trade that I've ever seen. And that doesn't mean the trade wins all the time, or that it doesn't mean it wins the most frequently. But it is a great trade to handle up and down markets, especially down markets, in an extremely effective way. The M3 is a little bit different. It's a lot different, actually. It's concept-based rather than rule-based, geared towards risk-averse people to be used as a monthly income trade. This trade is about learning to be an effective trader in all market environments, and it uses multiple combinations of strategies to do that. The mantra of an M3 trade is essentially to stay in the market, learn to trade complex options positions in all environments without losing money. This system has an extremely high win rate, and I would say is the most popular trading style within all my clients. It's a very popular trade. A lot of people, this is as far as they go. They learn the M3, they love it. Then from there, we have the rock trade we're going to be looking at, which is going to be essentially the next step in the progression to what we call the M21 trading style. And the rock trade would be something that somebody might move to after they've mastered the M3. It's a concept-based style that utilizes multiple combinations of strategies and concepts depending on volatility. So this is a shorter term trade that is risk averse like an M3 trade when volatility is high, but becomes more aggressive to produce higher returns when the volatility comes low. I would call the rock trade the highest yielding concept-based trade that I've ever seen, and that I'm sure you'll find that does not take any charting into account. This trade will usually outperform a bearish butterfly in most years, unless you get a year that's kind of leaning towards what the bearish butterfly is really good at, in which case the bearish butterfly may outperform it. But it typically has a higher win rate than a bearish butterfly trade, and the drawdowns tend to be less. So that's a really cool trade. And then we have the V Condor we're going to be covering, which is one of the 4 trades in the SSS trading system. And it's kind of the oddball trade in the SSS trading system. The other 3 trades work together. The V Condor kind of stands on its own. This is a rule-based condor trade for risk-averse traders. And it's a really interesting trade. It's a trade that I developed not because it was natural for me, but mainly because it was a challenge given to me by one of my students. If you've ever traded rule-based condor strategies for any length of time, I'm sure you're all too familiar with the problem that they have. And that is that, when they go well, they go very well, all is good and things are fine. But when they go bad, they go really, really bad, because most of the strategies you're going to see out there with condors often take on too much directional risk, and you're hoping things work out. And when they work out, all is great, but when they don't, it can be very, very bad, especially if your timing is off a little bit. So I was challenged to come up with a high probability condor trade that won most of the time, but didn't take on the excessive risk that most condor styles do. And this is what I came up with. It was the V Condor. So anyway, that's what we're going to be covering. So come on over to our website and check out our programs. You get more information on all those. Plus you can get the rest of the information on the super simple spread trades, learn what the M21 is all about, as well as APM squared, which are our more advanced programs. If you are would like to see a $1.25 million M3 style trade, you can join me after this webinar for a live trade review on Options Tribe, assuming you are an Options Tribe premium member. If you're not, you can go to optionstribe.com or smbtraining.com, and you can go ahead and join there. Also, if you have not put your results in for the Hawaii Challenge, go ahead and do that. And also, if you have not, if you'd like to participate in our Trader of the Month Challenge, then make sure you email Sherry at lockeinyoursuccess.com and go ahead and look at that. All right, so let's get moving here. We'll take a look at the markets. We have a situation where last week we were saying the Russell, as a matter of fact, not just the Russell, but essentially all the indexes were trading in a triangle pattern. And I was saying that this triangle pattern was rather steep, and we were probably going to break out of it and widen the pattern out a little bit, which is pretty much what happened. We broke out of the pattern here early in the week, and we just kind of reversed back down in again. So realistically, the price movement last week, as far as I'm concerned, didn't really mean a whole lot. What we're going to get this week is we're going to get probably a continued consolidation or a relatively sideways movement until we get the Fed announcement on Wednesday. It's not likely the traders are going to push for a hard breakout either way until that news is over with. So I'd expect essentially range-bound sideways movement between 1140 and 1170 till Wednesday. Probably not even that drastic. I'd say it's probably even a tighter range than that. And then we're probably going to get something meaningful, in my opinion, going to be a breakout higher. I think the traders are thinking that as well. Typically, what we're having here is what will most likely happen is we're probably going to settle in at a resistance area, right on the resistance area for Wednesday. And then we're going to break out one way or the other. That is, unless we get some advanced news, some sort of a leak that's going to hint that the market's going one way or that the Fed's going to go one way or the other, in which case you might see an early breakout if we get some kind of news leak. But other than barring that, I would expect very minimal movement till Wednesday. That being the case, this is expiration week. If you are in trades that are in September expiration and you do not have a lot of room for price movement on your position without taking a relatively large loss, I would probably exit the trades because you're taking on a lot of price movement risk. But I mean, of course, you're your own trader. That's up to you. If you get lucky and the market doesn't move, you'll make a lot of money right away. If the market does move significantly, then you are going to lose whatever gains or draw down some from your position here, and you're going to be too close to expiration to recover for it. So probably wouldn't be a bad idea to get out before then. I'm going to be out of some of my trades before then. So anyway, for October, of course, no problem at all, but I'm just talking September because we're at the situation where we only have, where we're basically at expiration day. Oh, okay, is it Thursday? Oh yeah, well, Thursday. I generally don't pay attention to news, but yeah, it's actually on Thursday. So I misspoke that. I would expect small movements till then. So and plus they're going to hold the value down in your position until that happens as well, or until they get some sort of indication which way it's going to go. Anyway, that's what I'm thinking for the markets here. Yeah, and I just have a question. Irrespective of small movements, would I expect volatility to increase in the upcoming week because of the news? Yeah, you're probably going to see the volatility crank up only in the September expiration options. They probably will not crank up in the October because realistically, by the time October expires, it's going to be a non-event. So you will see an inversion in the options with abnormally high volatility in the Septembers. My experience with low commission brokers, I don't know exactly what you would like to know about low commission brokers. I do like to use Thinkorswim, especially for newer people. If you're a newer trader, I would not worry about commissions as much as the ability to more accurately put in your positions. In other words, make less mistakes, because a mistake can cost you more than commissions for the month for sure. So generally like to see Thinkorswim for brokers, and you can deal with them on commission rates. I would not get a ticket charge. I'd get just a straight per dollar option if you can do it in your country. But I would just go with Thinkorswim. I'd pay the higher commissions for now, assuming that you're, and assuming Thinkorswim's available in your country. From there, Interactive Brokers is a very good broker. I had them in some of my accounts. I actually don't trade them anymore, but the platform's difficult to use, but they're a very good broker. LiveVol we use on the trading desk, which is also a good broker. I think the platform's kind of crappy, but the commissions are low. Both those brokerages, it's very easy on the platforms to make mistakes, which is why I tend to go with Thinkorswim. As far as the other small ones, I don't really have any experience with them, so I can't really comment on them. So hopefully that helps with that. Are they trustworthy? I don't know. I would be concerned about some of the smaller companies with very large accounts. I don't know if I go into a little known company with $1 million. If you have $10,000, I mean, it's not that big of a risk, but if you got a lot of money, I'd probably stay with somebody big. All right, so let's move on to our positions and we'll see what's going on there. I'm going to drag up option view and we'll run into backtrader here. And let's just go back to Tuesday before adjustments. So market hasn't been moving around a whole lot, but we are close to expiration, so we do need to make some adjustments here and there. Tuesday, let's see, was the 8th. So we did make an adjustment. Essentially, we were, by the end of the day, we were actually more than 10 points past our long strikes. And we're positive Vega, which on an M3 essentially calls for a roll-up. So we took this position here. This is the way we looked at like prior to adjustment. And if you look, the original butterfly here was actually at the 1100 short strikes. And if we just move to 1530, we sold out that butterfly as outlined in the program. We rolled it up 20 points, had to put in 10, 1120, 1140 verticals, put us in a situation where we were minus 52 delta, just inside the tent here, and everything looks good. So no issues with that. That was looking fine. So essentially the rest of the week we didn't need to do anything until Friday. So let me just kind of push up till Friday here. And at that point we're running too much negative delta. The system only allows minus 100 inside the tent. We are in a position that looks like this. So I went in and did, I believe, 5 1140, 1150 verticals. So we'll show you that. And this comes into, brought us down to minus 64 inside the tent, and this is the new position that we're looking at here. So we have 2 days left. Well, not 2 days left, but we have till Thursday afternoon. We have to decide when to get out of this. Of course, I will be interested in getting out of this at our profit target number. Otherwise, we're just going to kind of stay in it. It wouldn't be a bad idea, like I said, just to exit prior to Fed announcement. Just because it's going to be on expiration day. So that being the case, we'll deal with that. And like I said, I will go in and I'll find out the exact time of the announcement, and then we'll deal with it. You may even want to do a little bit earlier. Realistically, if the Fed amount is Thursday, I would still like to be out of this Wednesday. And the reason for that is the volatility is going to actually crank up quite a bit on Thursday morning. And they're not going to give you any money from going to Wednesday to Thursday anyway. So I'd probably just exit the position here. So that is the M3 trade. So up 5%. If we're flat for the next couple days and the market backs down a little bit, we may actually get up to close enough to our number where it might be worth closing. So that's going okay considering what's happened for the month. If we take a look at our rock trade, if you remember, the rock trade was also an M3 trade because of it, the way it was entered. We had a very tough month on this one, primarily because, let me move to the rock trade here. Primarily because of the entry date. We entered the Wednesday before, we entered on a Wednesday afternoon. We had a very hard down move on Thursday. We had a very hard down move on Friday. We had the virtual market crash the following Monday. So couldn't have been worse timing for this type of for a trade. So we drew down quite a bit during that process, but we're still alive here. And this is what we look like as of Tuesday. Oops, I'm sorry. This is what we look as of today. Let's go back to September. Let's go back to September 8th. This is what we looked like on September 8th. We essentially, we were not, this trade is similar to the M3 trade, but it's 10 points higher as far as short strikes go. Therefore, we did not outrun our long strikes here. So on Tuesday, instead of doing a roll-up, we just did some more verticals. So if we go forward to 1530, you'll see we did 5, 11, 10, 11 30s. Brought us to about minus 50 delta and gave us a position that looks like this. And then again, no adjustments till Friday, where we actually came in here and we're running over positive, too much negative delta once again. So I came in here and did 5, 11, 30, 11, 40s to flatten that out. And this is what, I'm sorry, I did 7. It's 7 of those contracts. And this is what our position looks like as of the close on Friday. So this trade is drawn down. The rules are kind of putting us in a weird spot right now. Technically, I do not go into a rock trade here until I've outrun this, which is generally going to be 10 points over our long strike or 1170. We're not going to hit that soon. We have, if we sit here, we're not very high theta. So we're not going to be gaining a whole lot of value. Basically, the market has to come down in order for us to get at least to break even here. I do allow in the rule set and the guidelines to go into a rock trade if I'm not 10 points above, and that's when I start having a positive Vega issue. So if I start having a positive Vega issue out here, in other words, the market creeps up in the next day or two, then I could maybe flip this over into a more aggressive position and bring the thing back. Otherwise, we are going to lose. So take a small loss, but probably a loss. So that's how that's likely to work out going forward. And let me see. Can I show a T-log? Let me take a look here at my questions again. Okay, T-log. Yeah. Let me just show some T-logs. Okay, great. So here's the T-log for this particular trade here. Again, we had a lot of moving around this month because of the extreme down move, the extreme market movement that we had this month, which wasn't terribly all that extreme. It's just that we had some very unfortunate timing with this trade, so which does happen at times. So that is the T-log for the September rock trade. If you're looking at the T-log for the September M3 trade, that is going to be here. So again, we had a bit of moving around due to the market movement. Okay, and let's see. That is all we have for September trades. The September bearish butterfly was closed at a profit. The September V condor was closed at a loss. The profit on the bearish butterfly was pretty good. I think it was like 12 or 13%. And I think the V condor loss was rather minimal. I think it was like 3 or 4% or something. We'll go over that next week when we do the results for the month. As far as our other trades, October, really no issues here. So let me go to an October bearish butterfly. This is our current position. There have been no adjustments on this trade since entry. So that is that. On our October M3 trade, we did get kicked back in this. We entered this and ended up rolling this back earlier in the trade. If we look at our T-log, we started out at 1130s. I think we had to roll back to 1090s. I think we ended up, and then we're back here. So we're all the way back to, let's see, selling the 1110s. So we rolled down, rolled back up again. So it's just been moving this all over the place. Here is what this position currently looks like. No adjustments last week, however. We analyze this. We're drawing down a little bit, but a nice looking trade here nonetheless. So everything is good. Notice we have 17 butterflies to 1 call. That's because of the volatility levels when we actually entered were rather high. So that's what our M3 looks like. This is still a very high probability good trade. It's going to work out. And then we have our October V condor, which essentially looks like this. So things are going fairly well with this trade considering all the movement. It never really drew down any, and it's been fine. So although you would be better off without the V in it this particular month, once again, so far, because the market's just been kind of sitting here. So that's what we have there. Okay, so let's take a look. I have to do a couple more questions here. With the volatility being high, would I still go into a rock position the next day given the Fed announcement? Yeah. What's going to happen with the rock position is you're going to have to go into an M3. So I would not, realistically, I don't think this Fed announcement is going to be that big a deal. I think you're going to get a breakout one way or the other. When the market breaks out, it's going to, let's just look at the charts for a minute. Right, when the market breaks out, this is either going to run up to around 1200, right, which is essentially a 40-point move, no problem for an M3 trade, or it's going to break down to about 1100, possibly to 1080 if things go really, really bad. Again, not a big deal for an M3 trade. And I don't think the move is going to be particularly fast. It's not going to be anything like what you saw here. So that being the case, I wouldn't be worried about it at all. I wouldn't enter a rock trade in a rock configuration, but I think the chances of that actually happening by guidelines would be almost zero. So you're essentially going to be entering an M3 trade on when the time comes, and just gonna go with it. So no problem there. I wouldn't have a problem with that. October M3 sag. Yeah, we can talk about that. So the question is do I think this sag is excessive? I don't think it's excessive. I do think it's kind of borderline to the point where it might be an issue. So one of the ways I deal with sag, I mean, you have the visual image, but I think a more accurate way to deal with sag would be, how much does the position draw down with so much of a price point movement? So I might say, well, with a 20-point price move or a 30-point price move, how much difference is it from here to here? When you look at this looks like there's a big sag because the position's drawn down. If we were in here and you were to look at this position and the position wasn't drawn down, so let me just hit 190.115 is what we paid for the call. Say we paid, just say we came in here and we didn't pay 190.115. Say we paid 170 for it. All right. And you look at the position now the sag doesn't look so bad, right? So when you're looking at the charts, you're a little bit confusing the actual sag with just the fact that the T+0 line's under 0, right? So the reality is there's really not very much sag there. And that being the case is really not a problem. Now, when this does have too much sag, then we'll start throwing verticals in, or we'll start taking off some butterflies if I think it's too much. But as of right now, if you look at, if you went by the T+0 line saying you're up $1,300 and I went, say, 20 points up, I'm still up money. It's only a $1,200 difference. With a position this size, that's not very much. And if I go 30 plus points, I'm still only down $400 from where I am now, right? I'm only down maybe less than 2,000 from where I am now. So I just don't consider that excessive sag. So just, don't confuse the sag issue with being under zero profit loss issue. 191.15. Okay, so I don't think it's that bad, and that's one of the ways I'll check myself, because this looks really bad, just because the position happened to get drawn down with that big down move that we had in the volatility increase. So that's the way I kind of look at that. Would I reduce the number of files? Oh, flies, yeah, to lower delta, yeah. So one of the things that we do here, when we enter a trade that has 17 butterflies instead of 10, right? Normally it would have 10 butterflies. So when we start doing adjustments, it makes sense a lot of times to start reducing the butterfly size. Typically what I will do, though, is I'll keep my butterfly size up and I'll add verticals. And then when the verticals get to the point where I start having a problem with capital, then I'll reduce the butterfly size. The only exception to that is if I really start having a gamma trend problem, in which case sometimes it makes more sense to reduce the butterflies. So my first move essentially on something like this would be some verticals to flatten the T+0 line out. If I can't correct the gamma trend effectively that way, then I'm going to reduce the butterfly size. Or if I run into a capital problem, I'm going to reduce the butterfly size. So those are the conditions under which I usually start reducing size. All right, so let's see. That, I believe, is all the trades that we have open. So far, that's all the questions we have. I will be entering the October rock trade on Wednesday. We still have over a week before we get into the rest of the November trades. So we won't be entering November trades for this Friday, but the following Friday, we will be entering a V Condor, though, on Friday, because a V Condor we usually enter when the month previous expires, and September expires Thursday. So we'll be entering that Friday. So hopefully that answers everybody's questions. Have a great week, everybody. And like I said, just watch the Fed announcement if you're in September positions. If some news leaks, we can get a decent move. Other than that, we should be relatively flat. So have a great week. Talk to you next week.